Welcome back to FT Markets. Europe has long been seen as the problem child of the global economy, but now people are starting to see it as something of an opportunity. This is a big shift, and here to talk to me about it is David Kelly, JPMorgan Global Chief Strategist for the asset management side of the business. Thank you very much for coming along.
Very glad to be here.
So you're one of these people who thinks that actually now investors ought to be thinking about getting into European equities.
Yes.
Can you tell me what you think has changed?
Well, I think the first thing is that Europe is beginning to turn the corner. If you look at GDP growth, it's very low on a year-over-year basis, hardly positive at all. But quarter to quarter, it's getting stronger. We had a good quarter in the second quarter. I think we're going to have a good quarter in the third quarter also. And we are seeing a pickup in momentum. I think the combination of stability in financial markets, which is really a gift of the ECB, and a little less austerity, just a slight diminution of the austerity, is allowing Europe to grow again. So I think the first thing is to recognize that it's turning the corner. Now, it's not turning the corner fast.
Right.
You know, this is not a Ferrari whizzing around the corner. It's more like a beat-up old Volvo trundling around the corner. But it is turning the corner, and if it continues to get better, it's really got a lot of room to improve.
And are you still worried about structural issues in Europe? Do you still think that there is a kind of fundamental problem with the structure of the eurozone that can't be resolved without some sort of?
I think there is a structural problem. You cannot have a monetary union without the ability to transfer money to countries who are really hurting. So I think a few years ago this problem could have been much more easily handled if there'd been more money going from central funds simply as a grant to countries like Greece and to a lesser extent Spain. That's a little bit water under the bridge, but I think going forward we need institutions to allow countries that fall upon hard times not to just languish there, because that does bring the whole eurozone down.
Okay, so we're on the brink of a cyclical rebound, you think, and why should investors think about European stocks as opposed to, say, stocks in the US?
Well, I think one of the reasons is because Europe has got so much room to grow. One of the things, the unemployment rate in the eurozone is 12%. The unemployment rate in the United States is 7.2%. But if you look back in history, it doesn't have to be that way. It wasn't that way in the 1970s and the 1980s. Actually, for much of the 1970s and 1980s, the unemployment rate in Europe was below the unemployment rate in the United States. So, Europe has been through almost an unending recession really since the launch of the eurozone. And I think people think that it has to be this high, but it doesn't. And if the unemployment rate comes down, I mean, I would say about 6% is, or 5 to 6% is full employment. For the United States, that's not a big leap, going from 7.2% down to 6%. But for the eurozone, if you can get the unemployment rate down from 12% to 6%, imagine how much, first of all, job growth, but then economic growth, and then earnings growth, which is a multiple of economic growth. So I think Europe just has more room to grow.
Okay, and are you worried at all about the strengthening of the euro? Do you think that that could in any way sort of threaten this cyclical rebound that we're seeing, that actually they might lose competitiveness just because their exports get more expensive?
Not too much. I think there are many areas in which I think European policymakers misunderstand the European economy. For each individual European country, exports are very important. But for the eurozone as a whole, it's actually European consumers that are important, because a lot of those exports are to each other. So it's not obviously a little bit of a headwind to see a stronger euro, and that does make it a little harder to export to other countries. But if European consumers and European businesses can get going, Europe can grow even without much growth in exports.
Okay, and you mentioned there the disparity between the unemployment rates and what that means for kind of room for catch-up growth. How about valuations? How are they looking relative to the
that's
US?
the second reason really to like European equities, because not only does I think our longer-term prospects better in Europe in terms of growth, but also European stocks are selling significantly cheaper. I mean, historically, if you look at PE ratios, using a cyclically adjusted PE ratio, which goes back over 10 years, there hasn't been much difference between the PE ratio for European stocks and for US stocks. But right now, European stocks are selling at a discount of somewhere between 20 and 30%. That is very significant. And so if you take the fact that the stocks are cheaper based on current earnings, and then you look at the possibility of earnings growing even faster going forward, I think there's a lot of long-term opportunity in European stocks.
Okay, great. Well, thank you very much for coming and putting the bull case. As people sometimes say, if you wait for everything to be perfect, then you'll have missed the moment to invest.
That's right. I think it's very important to, everything can't be perfect. You need to invest in a logical way today.